I'm Ross from Smith Property Accountants in Hamilton. Today I just want to go through a quick example. This is the first rental property that I could find that was a newish rental property. I've used Hamilton because that's where I'm from, so it's just easy for me to search, but just wanted to look at how does a rental property work that's a pretty average looking rental, newish property, but with only 3.4% interest rates. What does that do to a property and what does that do to a cash flow? So the first property that I managed to find is this property here. It's a low maintenance investment. Asking price 460,000. It's in Dinsdale. A lot of people don't mind Dinsdale. It's in a reasonable area of Hamilton, not my favourite. It's a 2-bedroom, 1-bathroom. It's built in 2016, so it's double glazing. It's relatively new, fully insulated. It's getting $435 a week, and it's got some body corporate. So what we want to look at is how does this work from an investment point of view, and with low interest rates, can it actually work okay, and what does it actually look like? So what I'm going to do is share my spreadsheet in a minute, and we're just going to go through the basic numbers and have a look. What does it actually look like? So I'll bring up my spreadsheet. Hopefully you can see my basic numbers, and I'll make them a little bit bigger, just trying to get it so you can see a little bit better. So we'll make it 200%. We'll make it big. So we're obviously looking at a Dinsdale investment, which is area in Hamilton. It's listed asking price 460,000, so let's just go with 460,000. I generally look at a property with no money in. So if you put money in, you're wanting a return on that investment. So yeah, the best way is to look at it with 100% debt. If it works well like that, then you can put some money in, you're obviously saving interest. It's a relatively brand new property, so I would hope to get 52 weeks. And at the moment, the property is rented for $435. One of the things I would do is I would get an independent rental appraisal and see, is the $435 realistic? Is it sustainable? Can you actually get that rent long term, or can you get some more rent? So I would have a look at that. The first sort of stat we look at is what's the gross yield? So 52 weeks, 435 a week is $22,620. That divided by 460,000 gives us a 4.92% gross yield. That's actually not too terrible for a newish house. It's only 3 years old. So it gives us a quick indication this is going to pay the interest. It's going to pay some of the expenses. Let's see how it is. Yeah, it's going to be around neutral, but we can see how it works out. So I factor in all the different expenses. Maybe you've already got a rental property. So generally what you'd look at doing is putting in the same structure, so your accounting would just go up a little bit. Generally, you would have insurance. This is a body corp property, and they actually gave us how much the body corporate is. But obviously, you'd look at long term. Is there actually a sinking fund in there? Is there actually some long term maintenance and things in there? So the body corporate was 1418. I would probably long term say that's going to go a little bit higher. That's going to cost me a bit more. At the moment, we're looking at 3.4%, sort of being the lowest interest rate at the moment. So we're looking at paying $15,640 interest if we borrow the full 460. I always include property management to try and put a realistic amount in there. Realistic rates, I'm guessing a bit on this property, but maybe they're $2,000 a year. It's a 3-year-old brick property. So you're looking at relatively low repairs and maintenance. It still will start to get more. I'd probably be guessing somewhere around $750. You then might go to some property seminars. If you've already got a property, which I allowed for in the accounting, maybe we won't include that. You might join something like Waikato Property Investors Association. So that might cost you a little bit. You might join as an individual. There might be a little bit of travel backwards and forwards to the property. So what I'm saying overall is you're going to receive $22,620. It's going to cost you $22,837. You're losing $200 basically a year. So this is a real neutral cash flow property. It's not amazing cash flow, but it's not hideous either. And like I say, it's an insulated, double glazed, 3-year-old property. It's actually not too bad a cash flow that you're not having to put in a huge amount of money. Chattels, It is 3 years old. The chattels will be getting a little bit less. So I'd probably guess that you might be about $3,000 a year depreciation. So you would depreciate, generally you would get a value at chattels appraisal. So you'd get them to value the carpets, the curtains, the dishwasher, stove, the heat pump, the fences, the decks, the driveways, the paths, all the different chattels, and you would depreciate all those chattels, which would give you a tax loss. Ring fencing has obviously come in from the 1st of April 19. So what you're probably looking at is if you've got another property making money, you should both to offset that and maybe save $1,000 in tax. Let's say your other property is not making any money either, then you'd get zero tax back. So it's costing you about $200, zero tax back. It's really costing you about $200 a year. So to me, yeah, this property is not amazing. It's not something fantastic, but with interest rates being so low, it basically pays for itself. And it means that you're not gambling so much on capital gain. You still do need capital gain to make it work, but at least it's looking at paying for itself in the foreseeable future. I then look at what's going to happen over the next 10 years, and that's a big guess. I'm being conservative and working on interest rates slowly going up to 5%. That doesn't mean I really think that's going to happen, but like I say, I'm trying to paint a bad picture and just be a bit conservative rather than painting the best picture and it not come true. So over 10 years, I'm anticipating that this property will lose $10,000 or $1,000 a year. And we're obviously hoping it would go up in value. So yeah, my prediction would be it would go up 351,000. That's a big fat guess. I don't have a crystal ball. No one knows exactly what's going to happen. But basically over 10 years, you'd be gambling $1,000 a year or $10,000 to hope it goes up 350. So that depends on what you're overall trying to do. It's not a cash flow positive property, but it's only slightly negative. It basically pays for itself with full mortgage, with property management, with accounting, with repairs, with all the other costs in there. So yeah, it's just something to think about. This is maybe still a bit average, but if you have a reasonable income and you think long term you could pay down a property, perhaps looking at a newer property when interest rates are so low is not such a bad idea. So yeah, hopefully that's just given you a little bit to think about. And the key things from that is, yeah, work through the full cash flow, work out what a property is going to make or break you. And yeah, some of the newer properties, low maintenance, good tenant, no hassles, no healthy home hassles, no insulation hassles are actually not too bad an idea, and they can basically pay for themselves. So just have a think about that, and yeah, watch out for more videos and newsletters we've got, and hopefully they can help you. Thank you very much.